Since oil prices crashed in 2014, the Nigerian economy has struggled to stay afloat, and so has the naira. The value of the naira has plunged roughly 160% against the dollar since 2012, a steep drop that has spiked inflation. As the scarcity of US dollar within the Nigerian banking industry continues to dampen down demand for imports, hitting manufacturers who have to look for local substitutes for their inputs. The nation's external reserves fell by $610 million last month, according to figures obtained from the Central Bank of Nigeria, dropping to $41.2 billion as of November 29 from $41.83 billion on October 29. Although the Apex Bank disclosed that at the present level, the external reserves could meet the country's 9 months import demands, economic experts are of the view that lack of foreign investors' confidence is responsible to the weakened naira, which is contributing greatly to foreign exchange scarcity. Let's now examine the impact of the continuous, of course, dollar shortage across the country and the outlook of the Nigerian economy. I introduced him earlier. He's the Chief Investment Officer at Afrinvest Asset Management Ltd, Mr. Robert Omotunde. Good afternoon, Mr. Omotunde.
Good afternoon, Tolu. Thank you for having me today.
Yes, I will start with the dwindling reserves. It's been up and down. Just like they'll say, the market is always up and sometimes down. But with all of the efforts, we see sometimes it goes on the high side and back to the low side. Now, to you, can you take us through what is responsible for this flip-flop that we see with regards to our reserves?
Right. So it's expected that the reserves will move from time to time in response to, the movement, of course, on the demand and supply side. Remember that recently, I think towards the end of September, we got some credits on the reserve from the, issuance that the federal government did at the international capital market. Now, that gave about $4 billion of accretion to the reserves. And we got also close to, I think, another $2 to $3 billion from special drawing rights. All of these impacted on the gross reserves. And by the way, let's put it in context. The reserve we see today is a 30-day moving average computation that is done by the central bank. So the tendency is that around the time when we were credited with that, with those amounts, you would have seen continuous increases in the level of reserves on a daily basis. But shortly after the, after that was done, after the next 30 days, we saw a normalization. Now, the what we call dwindling reserves now, it's a function of the intervention that the central bank is now doing. Remember, there is this bi-weekly sales that the central bank does to cater for the demand that arises either from PTA, BTA, their intervention in the I and EFX window and the likes. And all of these are expected at this moment because before now, remember that the central bank had a bit of challenge in meeting up with the demand, at the secondary market. I mean I and EFX window. Now, right now, because of the support which the central bank now has from the special drawing right and the issuance at the international capital market, they now have a bit of more leverage to push more inflows into the market. And if you notice at the alternative market, you've seen gradual moderation in the foreign exchange rates, and so this support is one of the things responsible for that, gradual moderation. So what I call what you call the dwindling reserve is what I call continuous intervention of the central bank in order to continue to support the currency and meet up with the demand that are eligible or legitimate at the I and EFX window as well as the official window. In order to cater for those demands, that's why you're seeing those reserves amounts dropping.
Let me follow up with the CBN that you mentioned before we move on. Many say the CBN is getting involved in too many things. Yes, I know one of the major things is to, of course, defend the naira and all of that. But when you look at all other sectors that you see the CBN intervening at this particular time, what is your reaction to it as a professional?
Okay, yeah. So I'm going to speak first as an economist.
Okay.
Then I will speak also my perspective of what the central bank is trying to do. Now, the mandate of any central bank, charged primarily with the, management of monetary policy. Oftentimes, we always keep it to price stability. In our client, we say exchange rate stability as well. Now, when you look at that mandate of the central bank and how the central bank is trying to resolve it, we know that there are so many issues within the system that are constitute a lot of shocks that are now impacting on the ability of the central bank to continue to function in its mandate of price stability. Take inflation, for example. Throughout 2020, we saw how inflation was, creeping up, and even down into 2021 before we started seeing some moderation around mid-year. Now, these are inflations that are influenced or driven by cost push factors, factors that are not necessarily within the purview of the central bank. Now, because they are cost push factors, you will notice that the central bank has not been majorly, increasing interest rate to curb inflation. Now, the reason is because you will put more pressure on the consumers if you increase inflation to curb a cost push or a cost-driven inflation. Now, so what you then see the central bank doing is now looking for the alternative. So if you are going to follow traditional principles, of what the mandate of the central bank is, you would expect that, okay, they should be raising interest rates in order to curb inflation. But there are other contending factors that the central bank then has to look at. And that's why most of the time you will not see that for every inflationary pressure, the central bank will increase interest rates. Rather, central bank is now looking for alternatives, things that they can do to ease pressure within the system while still trying to function within their mandate. So as an economist, you may want to say, yes, central bank is delving into so many areas they should not delve into, but on the flip side, the central bank can argue that what they are doing is still within their primary mandate, because all of the issues that are causing inflationary pressure, foreign exchange instability, there are things that central bank may not be able to directly impact. And I just give an example. To curb inflation, for example, in an environment where inflation is supply side factors, what we are seeing is supply side factors driving inflation, insecurity, shortage of, inability of farmers to go to farm and produce. All of these factors are supply related issues. Now, impacting it or trying to fight it by increasing inflation will only just worsen the situation. So rather, the central bank will now say, okay, what else can we do to address these supply side factors without touching, monetary policy tools such as inflation? So that's why I would likely, as an economist, I can, criticize and say, oh, central bank is doing more than it ought to do. But I say that central bank will argue and say they are still within their mandate, because all they are trying to do is to, look at the factors that are causing inflation rather than looking at so, you have the cause and you have the effect. So they are reviewed that rather than tackle the effect, which will eventually worsen the situation, let me seek to tackle the cause. And that's the argument of the central bank in some of the things that they do in intervening in the economy.
Well, there's been a level of growth, at least to a level witnessed for some time now, and even with the third quarter figures in. But with the Omicron variant and all of these restrictions all over, what is your outlook? It seems like it's not going to continue the way we expected it. What are your expectations? Will this not affect projections that have been made before now? Because one way or the other, international trade is important for us to be able to, one way or even our manufacturers need to bring in many of their process and raw materials from abroad. And when we have restrictions like this, what impact do you think it could have, first on the economy and maybe the business environment?
Okay, so I think that it's good to put our recent growth trajectory or achievement in proper context. Now, we saw a significant decline in 2020 on the back of lockdowns, dwindling oil prices, a lot of economic activities that slowed. Now, what we have seen so far in 2021 in terms of recovery, I dare say that it's just taking us to the point that we were in 2019, early 2020. We haven't really seen a significant growth driven by real economic activities that has happened. But because we suffered a dip in 2020, we are only just recovering. And in fact, if you dissect the growth quarter on quarter, for some quarters, we saw that we didn't even recover as much as we should have recovered. So that said, now with the Omicron variant that is now ravaging the world again, I think one of the lessons that the world has taken is we may not go back to the point where there is total lockdown, such that economic activities are now significantly impacted. Do not forget that a lot of institutions have devised means of, working remotely, at least for those that can do that. In my industry, for example, to a very large extent, you can work remotely and, still get your job done and even increase the level of efficiency. But for some industries, even for some industries where they cannot actually work remotely, there are other things that have come up relative to where we were in 2020 when there was no vaccine. Today, we are talking about some vaccines that have been developed. Even though the Omicron variants, from what we have, heard, it's, the virus, the vaccines that have been developed are not sufficient to tackle the Omicron variants. Some claim that, is significantly, potent to tackle it, while some others say is not yet. But be that as it may, what we expect will happen is that the pharmaceutical companies, the health care companies, will still continue on their research path. And I do not think that if there's a need for a booster for the vaccines that have been made before now, it will not take as much time it took us to get vaccine in 2020. Perhaps another 1 month, 2 months, 3 months, there can be a sort of booster that will be developed that will then help to, boost the immune system of those who have been vaccinated, so that you can also tackle this Omicron variant. And if I take you to what has happened in the market, about 3 weeks ago, when the news about Omicron was so dominant, what we saw across market was a significant drawdowns. If you look at the international market, look at sub-Saharan Africa, Eurobonds market, all over the place, we were seeing significant drawdowns. But what has happened from the beginning of this week, we have seen, in fact, since late last week to the beginning of this week, there have been significant recovery, such that the market has already recovered to the pre-Omicron levels, because the market has been able to digest that this variant is not likely to have as much significant impact as we had when we had the coronavirus originally. So we'll continue to navigate, and I think that there will still be several mutations of this virus, as we have seen. It's been here with us for the last 2 years, which means that there's a possibility that there will be several mutations. But by and large, I think that the vaccines that have been developed, will continue to be improved upon to protect citizens, such that there won't be total lockdown that will have significant impact on economic activities.
All right, when we're talking, staying with the growth, which you said, yes, we should put in proper context, and I like the clarity you just spelled out. Now, the non-oil sector seems to be becoming more active, talking about doing very well with proceeds at this time. And I spoke earlier to the DG of MAN, where we talked about Africa trying to trade with Africa, promoting trade across the continent. What's your outlook also for the non-oil space? How well do you think Nigeria is doing? Can we do better than what we're doing at the moment?
Absolutely, we can do better than we are doing at the moment. And let's be honest with ourselves, one of the factors that has driven the oil sector, the non-oil sector so far, is also partly linked to the pandemic. Because if you remember, when there was total lockdown, all financial institutions or what have you, companies that could work remotely, they had to leverage on technology in order to continue to work remotely. So that impacted on some sectors better than the other. So if you speak to those who operate with the telecom sector, for example, they will tell you that coronavirus has been a blessing for them. And we are still continuing to see the impact of that on the activities happening in the telecom sector. And if you dissect our growth structure, the structure of our economy, you will find out that services account for a significant chunk of activities within the non-oil sector. And in these services, we have telecommunication. Is about the biggest. you will find in the services sector of the Nigerian economy. Now, this sector continues to do well despite all of the issues reported about coronavirus and all of its mutations. What you continue to see is that the need for data usage is increasing, and because that is increasing, the likes of MTN and Airtel and all other telecoms companies, they continue to benefit from that significant impact. And you can see that in their numbers because, at least two of them are listed on the Nigerian Exchange Group, where you can see actually how they are performing. And I think that this will continue to happen. Now, other sectors within the non-oil sector, like trade services, have also seen significant improvement because we are seeing a recovery, like we said, from what we had in 2020 now in 2021. Now, what we now need to see is whether that recovery will be sustained. And now what we determine that is how much we are able to put a rein on price levels. Because when you look at the activities, economic activities, you may see increase in nominal terms in terms of economic activities. For instance, if you look at our GDP in 2020 relative to our run rate in 2021, you will see an increase in our numbers. But that increase may not actually be real by the time you distill it for inflation. So whether we will continue to see increased activity has to do with how we are able to put a rein on price levels. Because when the income of the people, do not significantly increase, what you will then see is that they will continue to ration the few amounts they have across goods and services. Now, if they have the same amount and prices have increased, what it means is that after rationing, they will get less in terms of quantity of another goods they want to buy because prices have increased. So that will definitely slow down economic activity. So whether we will see an improvement right now has to do with how much we're able to put a rein on inflation in the context that we are not likely to see significant increase in consumer income because of all the economic activities that even businesses are facing at the moment.
Let's end on that note, talking inflation, which you mentioned. As we look up to probably removal of subsidy by February, of course, electricity subsidy too might be out, and there is no increase in salaries and all of that. So what are you thinking would happen to inflation figures at that time? Some say we might go as high as another 3-4%.
Absolutely. I mean, each time there has been increase in pump price of petrol. Now, because of the direct and indirect correlation with most economic activities within the country, we see between most times 200 to 300 basis point increase in inflation. And if the prices we have been hearing is anything to go by, what the new pump price will be from the current level that it is, I bet that it can also add close to 200 to 300 basis points to our inflation numbers come 2022. Now, we can't run away from it. That's not to say that it is not good. Remember, we have argued it severally. It is better for the government to exit payment of subsidies. It's better for the overall economy. But what I think will happen is that consumers and the populace generally, we can now ration. The way I will behave when there is subsidy with the use of energy will be quite different. If I'm the type that will drive to work every day, and yet I have a colleague of mine staying close to me, by the time energy prices increase and I have to pay more for pump price of petrol, I can do a collaboration with another colleague to say, oh, why don't you drive my car this week? I'll drive yours next week. Human beings are rational. But most times when we try to give subsidy, we rob humans of their abilities to be rational. Because when I'm getting it for free, which is what we have been doing with pump price of petrol for a long time, some will even, move away from driving one car to driving two cars because the cost they are paying to maintain it is not as high. But when we have to pay the market reflective price, human beings will shift. You will see a change in how human beings behave, and definitely maybe human beings can now begin to ration and spend less on products. And then it will remove a lot of inefficiencies that are in government. People have argued that we are subsidizing the whole West African coasts, because all these products find their ways out of our country. So inflation will not necessarily be better, and that's the honest truth. However, we will see significant improvement in other aspects of governance. Maybe infrastructure government can now spend more on infrastructure, provided the proceeds we are able to save from fuel subsidy, we utilize it judiciously, and it doesn't go into fueling corruption.
I must thank you so much. I've been speaking to Chief Investment Officer at Afrinvest Asset Management Ltd, Mr. Robert Omotunde. Thank you very much for sparing time out of your busy schedule. We really appreciate this. Thank you so much.